In this video, I explain search for unrecorded liabilities. In a moment, you're going to know how to perform this very important audit test and nail it every time. So let me define what a payable is. So when companies receive invoices, they're adding those into their accounts payable system. Those are keyed in with the invoice date. And so, say a service is provided December the 27th. That date is keyed into the system, and it usually drives when the payable is recognized. Now, when that invoice is keyed into the system, it credits accounts payable, which is a liability account, and then the system debits an expense, which is an expense account. So expenses are going up, liabilities go up as we accrue the payables that are received or invoices that are received into the company. Now, when you perform the audit, you're going to have probably a long list of invoices that were due at the end of the period, but we need to know what to do with those, and we also need to understand that sometimes that list is not complete. So first, let's talk about this list of invoices that you've received. You're the auditor. And so what do you do with this list of payables that are due at the end of the period? Well, the directional risk for accounts payable is that it's not complete. In other words, that it's understated. So when a client gives you a list of payables, that's a good thing because they're kind of confessing, okay, here's what I owe. So there's not usually a lot of risk in the liabilities that are already recorded. The risk really lies in those that might not be recorded. So am I saying you shouldn't do anything with this initial list of invoices? No, feel free to vouch some of those amounts to supporting invoices, maybe some of the larger amounts. You also could do some comparative analytics, so look at the total payables for last year and compare that total with the amount of payables at the end of this year. So that's really about all you need to do with this initial list of invoices that you receive. Now let's talk about how to do the search for unrecorded liability. The real threat in accounts payable is that we don't have a complete list of all of the invoices received. If a client really desired to deceptively understate payables, then they simply don't key in all of the invoices they've received. Maybe they take some of those invoices and put them in a desk drawer until later on. So you want to know if they had some payables that were due at the end of the period but were not recorded. And that's why we're going to do this search for unrecorded liabilities. The first thing you're going to do in your search is ask for a check register. Now in this example, we'll suppose that the client year end is December 31, and let's say it's March the 15th today. I would ask for a check register for January, February, and the first couple of weeks of March. We're going to look at what was paid in that subsequent period to look for unrecorded liabilities. So the thought here is if your client has received invoices and they didn't record those as of December 31, well, they've got to pay those. Otherwise, the vendor could cut them off. So normally they're going to pay the invoices. And so we're looking at the January, February, early March payments to see if there were some amounts that should have been accrued at the end of December 31 but were not. Once I receive this list of payments that was made in January through say mid-March, I'm going to use a threshold to determine what amounts I'm going to look at. So let's say that this check register had 300 transactions. I might use a threshold, say, of 5,000 or 10,000 or 20,000. And every payment above that threshold amount, I'm going to ask for the related invoice and vouch the payment back to the invoice. And when I look at the invoice date, I'm trying to see, should this invoice have been accrued as of December 31? If it should have been accrued and it was not, then either there was an error or the client intentionally didn't record a liability they owed. Usually you're not going to know which, but at this point, most of the time, all we're going to do as the auditors is propose an adjustment to accrue those unrecorded liabilities at December 31. So we look at this check register, we pick our threshold. Let's use 20,000 in this example. I'm looking at every disbursement greater than 20,000, and let's say there's 25 invoices that were paid in January, February, and early March that were greater than 20,000. I'm now asking the client to provide invoices related to those payments, and then I'm just simply looking at each invoice and looking at the invoice date to see if it preceded January the 1st. If it does, then most likely it should have been accrued at December 31. Then, as I see those invoices that should have been accrued and were not, I'm creating a summary of those amounts that need to be accrued. Usually I do this in an Excel spreadsheet, so I'm listing the invoice date, the name of the vendor, the check date, and the dollar amount. And then the last thing I need is the chart of account number, because we're going to propose a journal entry and you need the chart of account number in order to do that. So is a search for unrecorded liabilities required by the audit standards? The answer is no, but I don't know that I ever do an audit where I don't do a search for unrecorded liabilities. The reason being is, as we said earlier, the directional risk is that payables are understated. And because this could be quite significant if there was a large amount that was not booked at the end of the year, I want to be sure that all of the material invoices have been accrued. So I do a search for unrecorded liabilities almost always.